Hi, my name is Gerardo Martinez, and today I'm going to be presenting to you my final project for the Master in Big Data Analytics. My thesis is named Stock Portfolio Optimization with Shrinkage Methods for IBEX35 and S&P 500. On today's agenda, we will have a brief introduction to the project, then we will discuss its relevance, moving to the literature review after that, and then also mentioning the objective of this study. Afterwards, we will discuss the portfolio optimization problem itself, moving then to the linear shrinkage concept, and then discussing the methodology that was carried out in order to complete this study. Finally, we will discuss the results and conclusions. The overall scope of this study is to evaluate the effectiveness of linear shrinkage methods applied to the estimation of the covariance matrix. This in order to understand its impact in the performance of stock portfolio optimization. This study focuses on two specific markets. The first one is the IBEX35, which is IBEX35, that's the Spain's market, stock market, and the S&P 500 for the American market. You may ask yourself, why is using alternatives to the traditional approaches relevant? Well, when we implement more statistically robust techniques in order to manage risk and maximize the returns, we can build better investing strategies, which translates to making money. Particularly, this study contributes by providing a complete analysis of how these alternative shrinkage methods can provide a better result than the traditional methods that usually use the sample covariance matrix. There have been many notable studies regarding this topic. It's always convenient to start by mentioning the modern portfolio theory, which was introduced by Markowitz in the 1950s. Moving forward to 2003, we find the work done by Ledoit and Wolf, which successfully introduced linear shrinkage as an effective alternative to overperform the sample covariance matrix when dealing with stock portfolio. Also, De Miguel in 2009, which, fun fact, he was a professor here in Universidad Carlos III de Madrid, went a step further by contrasting the performance of the sample covariance matrix baseline against many other matrices. Finally, in 2020, Nguyen and company perfected some of these techniques and tested them against the Vietnamese market. The objective of this study is basically to evaluate the performance of 5 different shrinkage matrices against the sample covariance matrix. The specific goal is to determine the best investing strategy for each of the markets, both the Spanish and the American indexes. The data employed for this assessment belongs to the historical data of both markets from 2013 to 2023. The shrinkage methods that are employed were the constant correlation model, the identity matrix, the constant variance matrix, the single factor model, and the Oracle Approximating Shrinkage. Since this assessment is based on making more money, an optimization problem is proposed with the objective function of maximizing the Sharpe ratio. This Sharpe ratio is a relationship that explains the total return that a set of assets can yield while considering the risk of the investment. So, in simple words, the higher the Sharpe ratio is, the better the investment is. The problem has two constraints. The first one imposes that the entire budget should always be allocated throughout the testing period. And the second one is that the weight values cannot be negative. This means that there is no short selling. The traditional approach uses the sample covariance matrix as a parameter for the problem. However, as I mentioned before, it can sometimes be susceptible to overfitting and instability. That's another reason why we will be using shrinkage methods. Now, it's time to explain the linear shrinkage concept. As many authors mentioned, linear shrinkage is pretty helpful for estimating covariance matrices, since it reduces computational errors. As we can see in the equation below, a new matrix is computed by blending the traditional sample covariance matrix with a more stable target matrix. This target matrix can be any of the ones we mentioned previously. The intensity of the blending of these two matrices is determined by an optimal coefficient. In this equation, it is expressed as sigma. As sigma grows, the target matrix will have a bigger influence on the estimation. As mentioned before, 5 different target matrices are employed. The first is the constant correlation matrix, which assumes a constant correlation across all assets. Later, we have the identity matrix, which proposes a main diagonal with variance equal to 1 and 0 elsewhere. The constant variance matrix assumes that the variance between every company's stock price is constant. Then we have the single factor matrix. This method uses a common characteristic of the companies, such as the market global performance, to determine the covariances between each of them. Finally, the Oracle Approximating Shrinkage, which is similar to the identity matrix method, however, it computes the optimal shrinkage coefficient in a data-driven approach, but not with a loss function. Once we have mentioned all the theoretical background, we can move on to the implementation. The steps employed were the following. First, we define the companies to be considered, then we retrieve their adjusted closest price, and then, secondly, we split the data in order to compute the matrices using the Sample Covariance Matrix baseline, and then the 5 different shrinkage methods. Then we proceed to optimize the portfolios for every single model for every single week. Then we backtest the result against the following week's actual returns, and finally contrast the overall performance. As for the data sets, as mentioned before, the Spanish and American markets were the object of the study, each with different characteristics and constraints due to their size and nature. For the IBEX35, the constraint in order to be considered relevant for the study was to be active for more than 6 years during the study period, having a total of 25 different companies to be considered. The official data was retrieved by means of Java Finance library in Python and Bolsa de Mercados Españoles reports. As for the S&P 500, since its dimensions are significantly bigger than the IBEX35, the constraint was changed. In order to be considered relevant, the company must have been active throughout the testing period. This gave a list of 314 companies. The data retrieval part for the S&P 500 was not as straightforward as with the IBEX35. Thus, web scraping techniques were employed in order to obtain the data. In order to efficiently evaluate the performance of the portfolios, a backtesting procedure was implemented. The backtesting procedure employed a rolling window approach to evaluate the performance of different portfolio optimization methods. Historical data from 2013 to 2023 was used, with a fixed window size of an initialization period of 5 years. This window rolled forward incrementally, by 1 week at a time, in order to simulate real-world trading conditions. At each step, the data within the window was used to estimate the covariance matrix and to optimize the portfolio. The optimized portfolio's performance was then tested on the out-of-sample data immediately following the window. This method ensured that the model was trained on past data and tested on future data, so there is no data leakage or contamination. As we can appreciate here, these are the average aggregated results for each month. On the top, we have the sample covariance matrix baseline in blue, and below in red, the results for each of the shrinkage methods. The green triangle next to some of the numbers means an improvement from the baseline. As can be seen, for the Spanish market, the shrinkage methods overperform the traditional method in almost every single aspect. A special remark for the constant correlation matrix with the highest Sharpe ratio of them all, which shows a 0.3 improvement from the sample covariance matrix Sharpe ratio. As can be seen on this graph, almost all of the shrinkage methods constantly outperform the baseline, having notable returns starting from 2021. It's also convenient to mention that the pandemic had a negative effect on Spain's economy, which can also be seen in this graph. As for the Sharpe ratio, which is the most important metric for this study, we can observe that all shrinkage methods outperform the baseline sample covariance matrix. Let's also mention again that the higher the Sharpe ratio is, the better the investing strategy is. The constant correlation matrix and the identity matrix appear to be the most attractive for the most attractive for their great performance against the baseline. The main takeaways that we can draw from the IBEX35 results are the following. The constant correlation matrix is the best performer in terms of returns and Sharpe rating. Also, all shrinkage methods outperform the baseline as suggested by the literature. And finally, the identity matrix offered the lowest volatility, which could be attractive for conservative investors. Moving on to the S&P 500 results, we can see similar behavior that we saw with the IBEX35, but with the difference that this time, not all shrinkage methods have better results when compared to the Sample Covariance Matrix baseline. Even though almost all shrinkage methods present lower volatility than the baseline, the Sharpe ratio is only better for the constant correlation matrix and the identity matrix. As we can see in this graph, the constant correlation model is by far the best performer in terms of returns, with the baseline and the identity matrix behaving closely to each other. In general terms, the American market presents higher growth and higher returns than the Spanish market. This is thanks to the larger set of companies and the fact that the pandemic in 2020 had not the same effect in these countries. Actually, the US economy had pretty solid years after. Again, in terms of Sharpe ratio, only two shrinkage methods were better than the baseline. The main takeaways from the S&P 500 results are that not all shrinkage methods outperform the baseline. Specifically, the constant variance matrix, the single factor model, and the Oracle shrinkage approximation showed improvement in terms of smaller risk, and that both the constant correlation model and the identity matrix are the best choices for investing in the American market, at least for this time span. It is also important to mention that the PyOps portfolio Python library employed for this study had problems while computing the portfolios for the sample covariance matrix, just as the theory suggested. So in order to get results for a regularization term was added to the main diagram. So it could be positive, semi-definite, and it could be inverted in order to actually solve the optimization problem. These might or might have not affected the results for the S&P 500. So it is important to note that. Just to wrap up a final conclusion, we can say that we have successfully proved the theory suggested by the authors to the Spanish and American markets. Also, linear shrinkage methods are a great alternative when optimizing portfolios. Finally, some future research could explore using these methods or maybe some other matrices or maybe some machine learning algorithms against similar markets like the Italian or French. These are the references. Thank you very much.